John Higgins, Mortgage One. Happy Monday. So to start out a new month and a new week, we've got big news again, kind of as we had mentioned in our last update. The Federal Reserve has raised the short-term Fed funds rate another 75 basis points. That would be two meetings in a row that they have raised the Fed funds rate. That's something that we really haven't seen ever, really. You have to go back into the early 90s to see this type of aggressive move. But we haven't seen this type of inflation really since the late 70s, early 80s. So certainly the Fed feels it calls for some drastic measures. And, when we get down to why the Fed continues to push the rate so high is, we've mentioned before, the Fed kind of lost control of inflation. And this inflation is not one that is easily remedied by the Fed. Their main tool is to raise interest rates. When we have such supply issues, as far as gas and food, energy prices, and that, it's very difficult for the Fed to have any impact directly on those types of inflation pegs. So what are they doing? They're raising rates and trying to curb demand. So that kind of brings me into a real quick little chart here that I wanted to show you. So we're looking at a market right now because interest rates have been on the rise. The economy technically is in a recession. We had a negative print in the first quarter of 2022 for GDP, and that was followed on by another negative print here in the second quarter. So we just got that information last week. So it looks like, we're in a recession. This one feels a little different because the economy seems to be going okay, and the job market is still unaffected by these increases in interest rates. So be interesting to see where that market goes. But I just wanted to show you a couple things. I have a couple charts. So I've got the 10-year chart here. We can see starting really January 2022 that home sales have really started to fall. We are coming off a bit of a peak here. So if you look at this 10-year chart, it kind of looks like we're reverting to the mean. I would say if you look at that chart, 5,500 is kind of the mean over the last 10 years. We've broken a little bit below that. Inventory levels seem to be starting to rise a little bit. Days on market are expanding. We look at the 25-year chart on existing home sales. Again, this puts a little better perspective because we bring in that big rise that we saw before the housing crisis in 2007 and 8 and 9 when the market really fell apart. So we're off some peaks, maybe not quite as bad. Looking at the long-term chart here, I'll say that we feel the market is maybe more in a normal range, but it certainly doesn't feel great out there coming off the really great market we had after the pandemic. So, and then, the last chart I wanted to show you is really what interest rates are doing. If we go back a full year on our 10-year treasury, we saw a peak, mid-June of 3.5%. If you look in the top left-hand corner there, we're at 265 this morning. That's a pretty big drawdown in a very, very short period of time. We're talking 45 days, and we've come off some 85 basis points. So the harder the Fed continues to push on short-term interest rates, it's having an impact on the economy. And as the economy slows, interest rates kind of far-reaching or far-looking, we're seeing interest rates start to roll over a bit. So certainly not back to the levels that we saw this time last year, but we'll take it where we can get it. Rates have moderated, and you should be seeing that with your customers now. So hope this gives you a little information. It's not all gloom and doom, but this market is certainly challenging at the moment. So if you need any assistance, certainly give me a call. Have a great Monday.